Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. We have a big episode today. It's the beginning of what will likely be a very busy week, so let's jump in. But first, two quick pieces of housekeeping. First, a correction. On my last episode, I misspoke a couple of times. One particularly glaring mistake was that I said the Democrat-dominated Senate in the United States. This is the complete wrong party. Of course, it's Republican Senate. I also said China update on two occasions rather than market update. My apologies for the errors. Second piece of housekeeping, this is a new channel. It is now in its second month, and I'm excited to announce that the channel is now going to begin monetization through sponsored features. Like China Update, my other channel, I want to reduce sponsored content to just 1 to 3 per month. This ensures that the channel is financially sustainable, and this is the least disruptive way of doing this. I like to choose 1 or 2 high quality sponsors to work with, have longer sponsored features only a few times a month, and thus have the rest of the episodes without sponsored features, so it's not very disruptive. If you'd like to know how I work with sponsored features, this information is in the description below. Now let's move into the episode. And we begin in North America. As most know by now, last week Canada's Liberal Party clinched a 4th consecutive term in office, with former central banker Mark Carney elected as the country's next Prime Minister. Carney will take the reins during a period of significant economic uncertainty as President Donald Trump's intensifying trade war drags on Canadian exports, business investment, and economic growth. Economists now project the country's economy will contract 0.2% in the second quarter and remain flat in the third, narrowly avoiding a technical recession. Business investment is forecast to plunge 3.8% on an annualized basis between April and June, while exports are expected to fall 12.1% during the same period. Canada's overall GDP growth is now projected at just 1.2% in 2025 and 1% in 2026, down from previous forecasts of 1.5% for both years, according to a Bloomberg survey of 34 economists. Nearly half of the respondents now assign a 45% possibility of recession in the next 12 months. February's GDP figures confirmed the early signs of strain, with the economy contracting 0.2% that month after a modest 0.4% gain in January. Preliminary March data showed only a 0.1% uptick, driven by retail and mining, which barely offset steep drops in manufacturing and wholesale trade. The economic challenges ahead will test Carney's crisis management credentials. A former Bank of Canada and Bank of England governor, Carney led monetary policy responses to the 2008 through 2009 global financial crisis and the UK's Brexit fallout. He has framed his leadership as the experienced hand needed to steer Canada through external turbulence. Quote, "Canada will go through a period of turbulence in the short term, but I'm confident in our economic fundamentals," end quote, the nation's finance minister said recently during the IMF meetings in Washington, adding, quote, "We will be relentless in protecting our workers and industries," end quote. Still, the worsening economic data has cast doubt on both major parties' fiscal plans. Carney's Liberals proposed running deeper deficits to fund infrastructure and housing projects, while the Conservatives bet on pro-growth tax cuts and deregulation to boost revenues, especially from oil and gas. Neither factored in the impact of a trade-driven downturn. Canada's central bank paused its interest rate cuts in April after a string of reductions beginning last June. The Bank of Canada governor cited the need for clarity on the impact of US tariffs before making further moves. The next rate decision is scheduled for the 4th of June, with markets split on whether another 25 basis point cut is likely. Quote, "The Canadian economy appears to be taking a bigger hit from tariff uncertainty than expected," end quote, said Andrew Grantham, economist at CIBC, adding, quote, "We expect a decline in GDP during the second quarter and a rate cut in June," end quote. Carney's leadership will now be tested not only by divided politics at home, but also a slowing economy teetering on the edge of recession. Next up, we move to Europe. A widespread power outage across Spain and Portugal, which we covered on Monday of last week, triggered a dramatic surge in usage of billionaire Elon Musk's Starlink satellite internet service, highlighting vulnerabilities in traditional telecom infrastructure and sparking debate over the resilience of Europe's mobile networks. According to data analysed by UK-based The Financial Times and provided by internet performance company Ookla, released over the weekend, Starlink usage jumped 35% above average during the blackout, with Spain recording a 60% spike on Tuesday as mobile networks struggled to recover. The outage knocked out thousands of mobile towers across the Iberian Peninsula, and only those equipped with backup generators remained operational. Although Starlink's performance declined under the weight of demand, it remained online throughout the blackout. Some ground stations in Spain reportedly lost service, but users were able to connect through infrastructure in neighbouring countries like Italy. Still, experts caution that satellite internet is not yet a viable large-scale alternative during crises, as users require sufficient device battery power, and the system cannot support millions of simultaneous connections. Spain's electricity grid operator has yet to confirm the cause of the outage, though some experts point to challenges in managing an unusually high influx of solar energy. The blackout revealed just how fragile telecom systems can be in the face of widespread energy disruptions. Network reliability in Spain dropped to half its usual level. Vodafone España reported backup generators activated at 70% of its sites, but by late Monday evening, areas like Galicia had just 20% mobile coverage. Telefónica said it restored 95% of its network within a day. The incident has renewed calls for greater investment in network resilience, though telecoms operators argue that costs remain prohibitive, particularly in low-margin markets like Spain and Portugal. Analysts say governments may need to step in, citing models in Norway and Australia, to ensure minimum levels of backup generation amid rising extreme weather events. Quote, "The blackout should be a clarion call for regulators," end quote, said Grace Nelson of Assembly Research, adding, quote, "Without stronger resilience, millions risk being cut off in the next crisis," end quote. And the next crisis may be earlier than we think. The United States of America is currently making sure that its national security isn't compromised. There are many moving parts, from trade to the dollar, as well as materials, the bedrock of the economy. Without them, the US will find it hard to compete with China. That's why the current administration has signed several historic executive orders to protect copper production and mining on US soil. Copper is often called the new oil. Copper demand is surging while supply struggles to keep pace, and all this while Washington is working to bring US copper production back home. Global mine production is expected to peak in 2026, with a projected 700,000 ton deficit in 2025 alone. Underinvestment in new mines has caused a supply crunch, and the US-China trade war has disrupted global copper supply chains. The world is hungry for copper, and this means big opportunities for savvy investors seeking to take advantage of this historic shift. And today's video sponsor, Giant Mining, provides such an opportunity. Giant Mining Corp, ticker symbol BFGFF, not only operates a copper-silver-gold project in Nevada, but also recorded its best ever drill intercepts in September of 2024. The company is the North American copper company to be watching. On February 14th, Executive Order 14213 was issued and implicitly prioritizes copper as a critical resource. Nevada, where Giant Mining's copper project is situated, has consistently ranked among the top mining jurisdictions in the world, which is why this company is being brought to your attention. Giant Mining's balance sheet is now fully funded for its drilling programs in 2025. Giant Mining is well positioned to accelerate its exploration efforts and potentially capitalize on emerging copper market opportunities. This is great news. The share price is down by 50% since early February due to all the market turmoil, so it could well be in a very underpriced position. Giant Mining owns the Mabuta Hill Copper Project, a past producing mine. In the past 4 years, management and the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining had their best ever drill hole. Historic underground mines in the project produced copper, tin and silver from the early 1900s to the 1950s, including 2.8 million pounds of copper, 184,000 ounces of silver, 5,800 ounces of gold and 21,000 pounds of tin. well below its all-time high, a mining-friendly administration, copper coming back to America, and a serious asset in Nevada. This is a speculative play, high risk, but also a potential very high upside. As such, giant mining is worth considering due diligence on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. Do your due diligence. A big thank you to Giant Mining for sponsoring today's episode of Market Update. We now return to regular content. Japan's Finance Minister Katsunobu Kato has suggested the country's vast holdings of US Treasury bonds could be used as leverage in trade negotiations with Washington, marking a rare show of strategic assertiveness from one of America's closest allies in Asia. In a television interview on Friday, Kato was asked whether Japan might use its long-standing position as a non-seller of treasuries as a negotiation tool. Quote, "It does exist as a card," end quote, he said, though he added that, quote, "whether or not we use that card is a different decision." End quote. Japan holds $1.13 trillion in US treasuries, the largest stake of any foreign nation. While there is no indication that Tokyo plans to sell these assets, the mere mention of such a move could inject fresh volatility into US bond markets. Traders have already been rattled by sharp swings since President Donald Trump announced broad reciprocal tariffs earlier this year. Kato's remarks follow a tense round of talks in Washington between Japan's chief negotiator, Reisei Akazawa, and US Treasury Secretary Scott Bessent. Sources say that discussions included proposals to lower non-tariff barriers on US car imports and increase Japanese purchases of American energy and agricultural goods. Quote, "This is a street fight," end quote, said Nicholas Smith, chief Japan strategist at CLSA, adding, quote, "You don't need to use the weapon, just brandish it," end quote. Analysts say the move signals growing confidence among Japan's leadership. Quote, "The fact that the extremely diplomatic finance minister spoke publicly about treasuries highlights Japan's willingness to assert itself," end quote, said Jasper Cole of Monex Group. Trade talks are expected to intensify in May, with hopes of a deal by June. Japan's treasury card may now be firmly on the table. Some analysts have pushed back, however. Regular viewers of my other channel, China Update, know that an analyst I often quote is Peking University Professor of Finance Michael Pettis. On this particular development, Professor Pettis had the following observation. Quote, "As always, the idea that countries like Japan can use their massive holdings of US treasuries as leverage in trade talks is a fantasy. For decades, we have heard similar warnings from other countries, and yet no one ever uses this leverage. This suggests that either participants in global trade conflicts are much nicer than we thought, or that countries with huge amounts of US Treasury bonds don't have the leverage they think they do. It is mainly the latter. Japan didn't acquire its huge holdings of US treasuries in a fit of forgetfulness or as a favor to Americans. It did so mainly to keep the yen low relative to the US dollar, mainly for the trade advantages this would bring. That is why it isn't easy for Japan to sell the dollars. Either they sell them for yen, which means a disruptive surge in the Japanese yen that would brutally affect Japanese manufacturers, who contribute about 19% of Japan's GDP versus the global average of 16%, or they sell them for some other currency, which mainly means euro. In this case, instead of forcing up the yen and undermining the Japanese manufacturing sector, they would force up the euro and undermine the European manufacturing sector, something which would anger the EU. Japan and much of the rest of the world acquired US dollar assets to balance trade surpluses, mainly because only the US is foolish enough to accept the so-called privilege. No one else wants it. The cost to the production side of the economy is too high." End quote. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for the next episode in a few days.